If your mortgage is renewing this year or next, your bank has already sent you a letter that is a financial ticking time bomb, and you probably don't even realize it yet. Most people treat this renewal notice like junk mail. They'll glance at the rate, maybe check one or two other websites, and then quietly sign the document, effectively locking their family into a budget trap for the next 5 years. This is precisely what your bank is counting on. They are betting on your laziness, your fear, and your inaction. They are using this massive, national renewal wave not to help you, but to silently rob thousands of dollars from your family budget. You should treat this renewal not as an obligation, but as a crisis point, an opportunity to either completely reset your financial destiny or surrender the next half-decade to crushing payments. Your life has changed since you signed that paper 5 years ago. The rates have changed. The market has changed. And the rules for lending have changed. Your bank isn't telling you the truth about your options, and the decisions you make in the next 90 days will decide if you drown in debt or finally secure your peace of mind. This isn't about saving a few dollars, this is about fighting for the future of your financial stability. Look, this channel is about exposing the quiet financial traps set by institutions and giving you the unfiltered playbook to fight back. If you value knowing the truth about money, debt, and the Canadian system, do yourself a huge favor right now and hit that subscribe button. Don't let their algorithms decide what financial information you see. We're breaking down the 3 secret things your bank hopes you never find out about your renewal. We are standing at the edge of the Great Canadian Renewal Reset, and the sheer scale of the shock is catastrophic. Over 60% of mortgages across this country are set to renew in the next 2 years. That includes hundreds of thousands of families who locked in mortgages during the pandemic at historically low, unbelievable rates, think 1.7% or 2.2%. Those rates were a financial party, but the hangover arriving now is brutal. When those mortgages reset into the current market rates, likely 4.7% to 5.2%, those families are facing mandatory monthly payment increases of anywhere between $300 to $600 per month or more for the exact same house and the exact same loan balance. Imagine absorbing that immediate, unexpected cost into an already strained budget where everything, groceries, gas, insurance, is already priced at record highs. This isn't just a tough year. For many working families, this sudden jump is the difference between making ends meet and drowning in debt. And here's the added layer of pressure that most people miss. This shock is happening against a backdrop of record high household debt and incomes that simply can't keep pace with the skyrocketing cost of living. Lenders are terrified of the systemic risk. Their appetite for lending is shrinking, their caution is skyrocketing, and their rules are tighter than they've been in a decade. They are scrutinizing every single file with a skepticism that did not exist 5 years ago. So, while you're worrying about the dollar amount of the payment increase, the banks are worried about whether you're even worth lending to anymore. This isn't just about a rate change, it's a financial chokehold being tightened around the neck of the Canadian middle class, and you have to plan your escape now before the letter arrives. Because if you wait, you fall directly into their trap. The biggest mistake people make is believing that their bank is sending them a renewal letter as a friendly reminder. That letter is not an act of service, it is a calculated profit strategy. What the bank is hoping for, what they are actively betting on, is inertia. They are betting you'll be too busy, too stressed, or too intimidated by the process to push back. They want you to take a quick glance at their offer, compare it with one other competitor's rate you found online, sigh, and then blindly sign their paper. Why? Because the bank's renewal offer is rarely, if ever, their best rate. It's the rate that maximizes their profit margins while minimizing their administrative effort. Here's their dirty secret: at renewal, your current bank does not have to re-qualify you if you accept their offer. They don't check your income, they don't look at your debt, and they don't pull your credit, unless you actively switch lenders or dramatically restructure the loan. All they are doing is sending you an offer that works for them. If you blindly accept it, you forfeit your chance to negotiate, to restructure, or to shop the competition effectively. You are no longer making a strategic choice for your family, you are just going along with what's easiest and most profitable for the bank. That is how thousands of Canadian families end up overpaying hundreds of dollars a month and getting trapped in a mortgage that hasn't fit their life, their new business, their car loan, their increased family size, for years. This passive acceptance costs you thousands over the term, and the bank laughs all their way to their vault. You have to understand that at this stage, you are in a negotiation, and your current lender is not on your side. They are trying to keep you locked in. Even if you successfully dodge the inertia trap and decide you want to shop around for a better deal or switch lenders, which is your right, you run headfirst into the qualification trap. The mortgage you qualified for 3 to 5 years ago, during the low-rate, loose money era, does not automatically mean you qualify for the same one today. This is the critical, undisclosed truth that will leave thousands of homeowners panicked. Even if your salary is the same or slightly higher, the new lending landscape has fundamentally changed two things: the stress test environment and the debt-to-income (DTI) ratio limits. Lenders are demanding more recent paperwork. They are scrutinizing every line of credit, every credit card balance, and every piece of debt you've accumulated since you first signed. The tightening of the DTI ratios means that the exact same debt load that was fine in 2020 might now put you over the limit for a new lender in 2025. Your bank might have been lenient back then, but now, every potential new lender will demand a full, invasive review of your entire financial picture. This is crucial. If you wait until the last minute and your current bank's renewal offer is unacceptable, and then you discover that your current debt load or a slight dip in your credit score means you can't qualify to switch to a competitor, you have zero leverage left. You are trapped. You are forced to sign whatever your existing bank offers you, regardless of the rate, because you are stuck. This is why planning is not optional, it is the only form of defense you have. You must run your numbers months in advance, check your DTI, clean up your credit, and see exactly where you stand. Otherwise, a small change in your life, that new car loan, that home renovation line of credit, can be weaponized against you, cementing your servitude to your current lender. It's time to stop reacting to their letter and start executing your own battle plan. The first thing you must do is seize control of the timeline. Find your maturity date immediately and mark it down. The reason that date is crucial is because most lenders will allow you to lock in a new rate up to 120 days before your renewal date without paying any penalties. But the real strategic window is even wider. You need to start planning 6 to 12 months out. That's the ideal time to run a full financial triage. Don't wait for the bank's letter, proactively run your numbers, check your debt-to-income ratios, and get an actual credit health check. The earlier you start, the more options you have to correct anything that might affect your requalification, like high credit card balances or any missed payments. The next essential step is figuring out the true, new payment shock. Use a realistic, professional calculator, not the rosy, cherry-picked estimate your bank sends, to figure out exactly what your new payment will look like if you are forced to renew at 5%. This is the part that will shock people. Coming off 2% and going to 5% often means an extra $400 to $600 a month coming out of your budget for the exact same mortgage. You must face this nasty surprise now so you can prepare your cash flow and your budget with breathing room, rather than being ambushed. Once you have that frightening, real number, you can move to the next stage, choosing your weapon of defense. We can't let them dictate the terms, we have to restructure the entire foundation of the mortgage to fit your life. If your cash flow is about to be devastated by the payment shock, your only path to freedom is to strategically restructure your mortgage. This is where you turn the renewal from a disaster into a calculated move. Here are the 3 power moves you need to consider, each a financial weapon designed to stabilize your budget. 1. The amortization extension, the breathing room. The first move is reamortizing. You can extend your mortgage term, for example, from the remaining 20 years back up to 25 or even 30 years. Yes, you will pay more interest over the total life of the loan, that's the trade-off, but it will drastically drop your monthly payment and instantly free up cash flow when you need it most. This option is best for homeowners who need immediate, significant relief on their monthly budget without increasing their total debt. It's a temporary shield against the payment storm. 2. The refinance roll-up, the debt destroyer. The second, and often most powerful, option is to refinance. If you are carrying high-interest consumer debt, car loans, high credit card balances, or lines of credit, you can roll that crippling debt into your new, lower-interest mortgage. This move can literally save families $800 to $1,000 per month in interest payments alone. It simplifies your financial life and frees up massive cash flow by consolidating multiple payments into one lower-rate mortgage payment. It's a total reset for families feeling stretched thin across different high-rate payments. 3. The HELOC Lifeline, the flexibility tool. The third option is adding a home equity line of credit, HELOC, during the renewal process. This gives you immediate, flexible access to cash for renovations, emergencies, or large expenses without touching your main mortgage and without committing to a higher monthly payment right away. This is best for those with variable income or those who want a secure emergency fund that is always accessible. The key message here is to stop chasing the single, lowest rate. That's a fool's errand. Focus instead on choosing the structure, the combination of these weapons, that fits your cash flow, your risk tolerance, and your family's game plan over the next 3 to 5 years. You must focus on what you can control, your plan, your preparation, and your courage to negotiate. The truth is, if you're approaching renewal, you are standing at a major financial crossroads. The bank is hoping you'll wait until the last month, assume their offer is the best you can do, and sign without questioning. That assumption will cost you thousands. We've exposed the trap, the shocking payment increases, the bank's secret profit motive, and the qualification hurdles designed to keep you locked in. But we've also laid out the battle plan: start 12 months out, force a full financial review, and choose a strategic restructure, reamortization, refinance, or HELOC that reclaims your cash flow. This isn't just about saving money, it's about reclaiming your financial independence from a system that is actively betting on your failure. You have options, but only if you give yourself the time and the knowledge to explore them. Don't be a victim of the renewal crisis, be a strategic survivor. If you are serious about getting ahead of this, if you want a second set of eyes on your specific numbers and a custom structure built for your family's unique situation, don't wait. Send me a message now. I will walk you through a full renewal review to calculate your true payment shock and build a structure that actually makes sense.